All right, hello everyone, and welcome to the live Q&A for September 20th of 2023. We had Fed announcement day today, so if you're watching this live, of course you guys can always ask me any questions at any time, and I will answer them as we go. Now, today I had some feedback actually from a few days ago, and I've gotten this feedback quite a few times. And as I've gotten this feedback, I figured I really needed to do a live Q&A about it and just really talk about, in general, some of the more basic things, some of the more beginner type option things. Because what ends up happening is I typically talk to more advanced options traders and more advanced topics and things like that, and I've definitely forgotten what it was like when I first started trading and kind of the beginning ropes of things. And so we're going to talk through some more basic things today. We're going to talk through some more basic structures. We're going to talk about what's the difference between structures and strategies and how they interplay, and how sometimes structures and strategies can both add significant power to accounts and things like that. So without further ado, let's just kind of jump right into it. And I'm going to zoom out and kind of get solely on the screen here. And so that way we can talk about different structures. So we're going to go from basic to more advanced, and then we're going to talk about the difference between a structure and a strategy at the end here. So let's first start out with just making a random structure here. And I'd probably just say one of the most commonly known structures and strategies is just a simple call or put, right? And so we're just going to kind of throw those on here, and then we'll eventually, dig up to more advanced things. So I'm just going to put a single contract on here. I'm going to try to keep this small. So here we're just on the SPX, by the way, which is the kind of my choice of index as far as what to trade on and things like that. But you can do any of these pretty much on any structure, any asset. So with a single put, this is probably kind of where it all started out. In essence, what happens is with a single put, the reason why this structure is advantageous, and I'm going to do this for each structure, kind of what's the point behind it and what's kind of its optimal type of environment type of thing, right? So a put, you can see here, there's a red line here, there's a green line, and then there's a dark green. The dark green here is basically what the value of this option is going to be when it decays all the way. So we've got 27 days in here. You can see that right here, up here around the weekly 06 July 2020 or 22, right? I'm in a back trade right now, so I'm significantly further back in time. I'm in June of 2022. But you can see here, if I were to hold this for 27 days and go all the way down to zero and the market not move anywhere, I would lose all this value and get all the way down to the bottom of this. This is why puts were originally called as like insurance, right? It's to protect if your portfolio or if your stocks go down. And what this does is basically as you can see, you rise up. There's positive numbers over here, positive numbers over here. Everything above this flat line right here is positive. So if the market goes down quickly, we can make quite a bit of money. And this light green line is what's called a T plus zero line. And this T plus zero line is where we can sell this option. Basically today, if this market moves, we can sell this option back to the market. We don't have to hold it all the way to expiration, right? So that's something that might be new to some of you guys right now. Also is that some options, or if you choose to, you can always sell the option back to the market. And this is basically like a stock. If you buy a stock, you don't have to hold it for 30 years, right? Even though that might have been your original intention, you can sell it back to the market at any time after you bought it, right? And that's the way options work too. So you can do that any day at any time before the option goes to expiration. Now, we are here at the money right now. So this is ATM, right? I've said that a few times. I want to make sure that I speak about terminology, because I also had a bunch of questions about terminology, and I want to make sure that we clarify all those, because definitely if you get into any of our strategies at eTrading Edge, you definitely have to know some terminology, because I definitely don't do a good job at that yet of telling, like having a good set glossary, I should say. All right, so as the market comes down, we make money. And as the market goes up, we lose money. If the market sits still and time decays, we lose money. If the market doesn't go down far enough, we also can lose money at expiration. So they're all various ways of how we can make and lose money. In general, right? In general, this is a negative performing asset, or a negative performing structure over time based on just statistics, right? So if you buy this over and over and over and over and over and over and over again, you are negative time, you are negative, generally your negative probability, because the market typically goes up, and you're also technically also positive vega, and the market typically is negative vega. That's a totally different animal, but we're trying to be a little bit more beginner friendly on this one. So we're just going to go through these. All right. So of course we can flip this around. So just as much as we can buy an option, like buying a stock, we can actually sell an option, right? Now, I know this might, blow the mind to some, because I remember when I first started out, I was like, wait, what do you mean you can like short a stock? I can sell stock before I buy it? It almost didn't make sense to me. But it's basically the same thing with an option. You can sell an option even though you didn't buy it first, right? So you can basically choose which side you want to be. Do you want to be a seller of an option, or do you want to be a buyer of an option? The market already had all these options in inventory. So just kind of think about that. As soon as you become the seller, you are then the seller of that option, and you take it away from the inventory of the market, I should say, right? So it's in your inventory because you sold it, right? So kind of think about it like that. Don't worry too much about whether you're on the buyer or the seller side, and it is what it is. All right, moving more forward here. So this is the seller side, and generally we are positive expectancy with this trade. We definitely would have most of the time the market goes up, most of the time the market's negative vega, and most of the time time is in your favor as well. So these are all kind of added edges that will end up making you money over time. The only unfortunate thing about being a negative put or a short put here is what ends up happening is when you do take a loss, they typically are much larger than when you actually make money, and that's because there's this not quite infinite loss because the asset can't go to zero, or it can't go beyond zero, but the idea that the market can come down here and you can lose quite a bit of substantially more money than what you're actually selling here is the whole point. So this is what's called typically you'll be like a cash secured put or things like that. Anyways, we are not going to go too far into that, but just know that that's kind of the Achilles heel of selling a put. So what a lot of people do is they move on to our next structure. Well, before I do that, let me just talk about calls. So we'll talk about a call. So a call is basically the opposite of a put, right? You make money to the upside, you lose money to the downside. You're still negative. You're still negative time, and you're still positive vega. So there are some disadvantages to this as well. And then of course you can be a seller of a call as well, right? So you can be both a positive or a negative on any calls. Now I'm still at the money. You can move any of these structures out. So we can be -1 out here, right? You can see that I'm moving out of the money. I can move this even further, so where I'm like 41.90, but yet the market is trading at 40.85, right? So this is what's called an out of the money call. So I'm selling an out of the money call, or I can buy an out of the money call, right? So anytime that you say something is out of the money, all it does is mean that wherever I'm buying that call, whatever my intrinsic value starts to pick up, right? So the intrinsic value is this angled line where I actually start making money at expiration. Where that intrinsic value starts out is somewhere that's not right at where the market is trading. And so that's called out of the money. You can do that on the calls and put sides. So see, I can come down here below where the market is, 40.85. I can go below this all the way down to, I don't know, 39.80. And I can buy a put way down here. See? So calls, puts, you can buy them all over the place. You can buy them out of the money, and you can buy them in the money. And so then you start out with a little bit more intrinsic value. You're starting on this angle line, right? All right, so what our next structure? Well, our next structure is, you know how I was talking about, the problem with this is that you have these large losses down here because you're on limited loss, and a lot of people really want to sell these puts, right? Because there's a lot of money in them, and the market typically goes up, and all the edges that I originally explained. Well, so what people started to do is they go, well, what if we hedge this off, right? So hedging, of course, means that you're buying something to protect something, another position that you have. So let's say our position is a short at the money, and we want to hedge this off. So we're going to buy something to hedge it off. So we hedge our risk by buying a put further below the market, right? So that way, if the market does go down, it caps off our losses, right? So all we are is selling one, and here I'll just eliminate this guy so you can see I'm buying a put down here, and at some point in time it will start making money if the market goes down, versus selling the put up here at the money, right? So we add both of these. This is called a vertical. So this is a new structure. So we had single options, which were our calls and puts, and then now we have combinations, right? And from this point on, all structures are realistically combinations of this exact structure. We're just going to be hedging in different ways in different areas and things like that. Now anything that's a vertical based structure is going to be like this. Now, vertical based structures, we're eventually going to get into horizontal based structures. But first, we're going to say, okay, vertical structures. Vertical structures are anything that goes across where the strikes are. So like the market's trading at 40.85, and what if we go down here to 4,000, right? So we're moving vertically. You can even see it here, right? Vertically, I'm going up to down, down to up on the options chain, right? You can see that over here with my little mouse. And the reason that I talk about vertical, because inevitably we're going to get into something called a calendar, which will be something more of a horizontal spread. But anyways, we'll talk about that later. Let's stick with this vertical spread here. So now that we've got this vertical spread, this is a structure. And this structure really benefits from what's called positive delta, right? So that's a Greek down here that says positive 14. And this positive delta means that as the market goes up, this trade will make money. And what's also nice about this is typically as markets go up, their volatility compresses or relaxes. And so this has an added bonus of getting a little bit of extra money as the volatility suppresses in this. And then on another positive is if we were to lose money on this structure and the market were to come down, this is positive vega back here. So you can actually see that down here in these little charts right here, these little graphs. You can see vega, and it's positive. It's a positive number. They're blue down here to the left. And that means as the market freaks out and explodes and the volatility widens and possibilities widen and stuff like that, this will actually support itself really well down here. So this is a really nice little trade. So this is what's called a put credit spread. And just to kind of go with my terminology, This is not going to be accurate, and someone's going to call me out on this because of the way that I'm going to say this, but it's the way that I'm going to stick from this point on because it makes the most sense to me to just call it like this. So this is a put credit spread, and then I call a call credit spread the opposite. And the reason why I kind of call these credit spreads in general is because you're receiving a credit. And what I mean by like receiving a credit is that you're getting premium, right? You're getting this credit if the time decays in your favor. So I just call it a credit spread. So that way it just avoids any of this crazy confusion by puts and debit or credits and debits and things like that. So if you have a credit, so you're going to be obtaining money at expiration, it's a credit spread. And then we can flip this around and talk about a debit spread. So a call debit spread would look like this in my terminology, right? And so this is, of course, you're losing money at the end. So you're in a debit, right? You're going to be in a loss if you lose all the way to expiration. And then you have a credit up, and then you have a credit up here. But as it stands right now, this starts out as a debit, right? So that's the way that I kind of think about things is where this angle is kind of facing, right? So if the open side of the vertical is facing away from where we are, it's going to be a debit spread. If the angle is opening towards where the market is or where we are right now, it's going to be a credit spread. So we'll throw a credit spread up here one more time. So here's the credit spread. All right, now that we've got our credit spread all set up, so this is, in general, this is a bearish credit spread, so a bearish call credit spread. And the reason why it's bearish is because it has negative delta this time as opposed to the put side. So if the market goes down, we make money. One unfortunate setup with this trade is that it is negative vega below the market, right? So you can see here our vega stays very negative, and it is positive vega above the market. And so if you think about this, when the market typically goes down or a shock happens to the market, typically volatility increases. And so what you'll see here is that, and I'm just going to use a little volatility adjust here, what you'll see is that the market will come down and you'll actually not make as much money as you think, because what typically happens is this volatility kind of stabilizes this loss right here. So on a T+0 line, it will kind of stabilize. And so you won't kind of make as much. So instead of, making 16,000 right here, right? Of course, the model kind of assumes that you'd make, roughly, 20,000 or so. But that's not actually what's going to happen because that volatility is going to kick up. So keep things in mind like that. So even though this is a bearish setup, this isn't not always the optimal way of becoming bearish on a market. Okay, so now we're going to go into more complex structures. So we've talked about verticals, which verticals you've got credit spreads and debit spreads. You can make them out of puts. You can make them out of calls. You can do whatever you want with them. You can face them towards the money. You can face them away from the money. They call them different things, but they do different setups, right? Of course, if you've got a bullish put or a bullish call vertical here, that is a debit spread. Of course, you get this big money to the upside, and it kind of works kind of like like when you buy a single call, right? So like if I were to buy a single call right here, you can see it kind of works the same way. But because I'm selling some options up here, it makes it to where the decay isn't as bad and it's a little bit more stable, just as far as where the market goes up, and my crossover stays a little bit closer. So that way we can actually make a little bit of money quicker and more stable as the market goes up. So that's one reason that people use debit spreads a lot, or verticals, I should say. All right, now let's do a combination of a vertical. So we're going to do probably the simplest combination of a vertical that most people know of, which is a condor. So we're going to put a vertical below the market, and then we're going to put a vertical above the market. Now I'm making this what's called an iron condor. But an iron condor or a condor is pretty much all the same. It's just whether you're making them with all puts or all calls or calls and puts. So what I did is I did a credit vertical on the put side and I did a credit vertical on the call side. And this makes a condor, right? And so with a condor, this is a really cool trade, is that if the market sits still, you can make a lot of premium, but yet if the market blows out on one side or another, you actually don't lose as much as the premium that you collect. And the reason why this is because this credit spread is reducing the cost of this credit spread and vice versa. And so it's really nice. But in the middle, you actually get to collect all of your premium. So that is another structure. I really like this structure, especially for a structure that, the market's sitting still, things like that. But actually the next structure is my favorite structure, which is a butterfly. So instead of having a smaller spreads out here, all a butterfly does is it moves the vertical to the same strike. So we're going to be at 4,100. So let's move this guy all the way up to 4,100. And let's make this guy even so we're not doing anything crazy here. So what we did here is we basically just put all of our strikes for our shorts, right, for where we're going to be selling the options at 4,100, and that creates a point. So that's all the differences between a condor and a butterfly. They're still the same structure. It's just that one puts all of theirs in one point and one spreads it out across a little bit more strikes and kind of has a flat top to it, right? So that's a butterfly. And then from here, there are variations of butterflies and condors, right? So you can break the wing of a butterfly. You can break the wing of a condor, right? So if I were to move this back out and move this back out, right? You can see that I have a condor again with a flat top, but what I've done is I've broken one side. And what this does is it fixes delta and stuff like that. Now I'm going to get a little bit more advanced here, but no matter what, the way that I see these trades is that this is not a single structure anymore. This is a condor with a vertical under it to offset this delta. I'll get into that into another video because that gets a little bit more complex, but I just wanted to let you guys know that you can manipulate the sides of these condors to get them to do different things. And that's where it kind of starts going into a strategy. But we'll talk about strategy here in a little bit. So what's another structure that we can have? So these are vertical-based structures. Now we're going to talk about kind of a fun structure here. This is what's called a ratio spread. So a ratio spread is a vertical, right? So we have a vertical and a call or extra calls on one side, so, or extra puts. So you can see what this does here is there's a vertical underneath this, but then I bought 5 extra puts down here. And this creates a unlimited win situation, right? With a limited loss at the money and then a little bit of a dip down here. Now this is a ratio spread, so you can do ratio spreads to the upside, the downside, all sorts of different things. There's all sorts of different ways. And there are fractional differences in ratio spreads. So right now I've got a 10 to 15 or basically a 3 to 1 or a 2 to 3. So then we can go so we've got -2 and we've got 3 back here, and you can see that it looks the same as what I had, right? A 2/3. And then we can go a -1 and a 2, right? So that's a different, you can see that it created significantly more loss up here, but it's a more powerful ratio spread. So you can do different ratios on your ratio spread. That's why they call it a ratio spread, right? Okay. So now let's go with something a little bit more interesting here. Now we're going to talk about a different structure. And now, so you know how we were talking about how we have calls and verticals to make ratio spreads. Well, what if we have a structure with an option with stock of the underlying? So first I'm going to just throw a stock up here. So let's say that we have 100 shares of SPX. And before someone says it, I know that you cannot buy shares of SPX, but you can buy shares of stocks, and I'm just using this as a model right now. So you buy 100 shares. So you can see here, there's no time decay in this. Technically, you can hold it forever. There's no expiration. It's just forever, right? This is a basic. If you buy shares of something, this is exactly how it looks. There's a straight line up and a straight line down, and it has 100 delta. So what some people do is they do what's called covered calls, right? So covered calls are where you have a long position underneath them, and then you sell a call or a multiple of them above the market. Now, in this case, you can see what it does here is it creates a structure that has positive time premium, right? As the market goes up, you have negative vega, right? And you've got this nice flat spot up here. So if the market goes up too much, you will start capping off your extra money that you've made. But anyways, this is a way that you can add time premium or add decay to your options. And so that's a really fun one, right? Or add time decay and add a little bit of extra premium to your stock positions. So it's called augmenting your stock positions. So of course you can do that with any sorts of combinations. So you've got a long back here, and let's say you want to put protect your long position. You can come down here and buy. You can come down here and buy puts, and it will cap off your losses if the market drops really hard. And you can, of course, see that it starts to look like a call, right? So it's kind of funny how when you start combining a position right here, which in this case I have 100, with options, you can create other structures. Okay. Now let's go a little bit more nutty, and let's talk about something like callers and stuff like that, right? Okay. So here's another structure, right? And this structure is where you can see I basically don't have any risk at expiration here. But if we do get a large move to the downside, I can very much make quite a bit of money. And if we get a large move to the upside, I will end up actually losing some money. This is a real good way to just get like a sort of a synthetic position or something like that to just get like your synthetic delta with options. So that is always a viable structure. A lot of people will do that on zero DTE and stuff like that to get some sort of delta exposure for a large move in the morning, but yet don't want to take the full risk of the market sitting still all day. All right, now let's talk about some horizontal spreads. So horizontal spreads are a little bit different than vertical. So far I've been working up and down on the options chain. Now I'm going to be going from left to right. So if we find the, let's say at the money right here, and we put in an option. So we're going to sell a put right here. And then instead of, buying it up or down on the vertical chain to put a vertical on, I'm going to put a horizontal spread. So I'm going to go out one expiration from here, and I'm going to buy something to hedge this off. Now, this is where things get a little bit interesting, but this is basically what's called a calendar. And the reason why it's called a calendar is because we are more calendar days out from where our short is. And this creates a position that is supposedly positive in our theta or time decay, that we should make money, because theoretically This option that expires in 27 days should be decaying, quote unquote, faster than the option at 29 days. I am not going to get into why that is false right now, but a lot of you guys that have been following me for a while or that are part of my systems definitely know that that is some BS. So what you can say, though, is that there are significant edges in the structure, and we use calendars all the time. Now, this is a regular calendar where you buy a calendar, and then you can also sell a calendar. One thing I am going to say about selling a calendar is that most brokers will not let you do this, and that's because your short is expiring out here further in time than your long. So keep in mind that most brokers will call this illegal unless you're on portfolio margin or something like that. So you've got to deal with that. Of course, as an institution, you can do this, no problem. But that's because institutions are on a totally different margin type of setup. Very close to portfolio margin if you're a portfolio margin user. So you can sell calendars, you can buy calendars, then you can do what's called diagonals. So far I've been going perfectly horizontal on my expirations. Now I'm going to not go horizontal. I'm going to go out and down. Boom. So you can see what this does is it leans the position. This gets us into what's called a diagonal, right? And of course, we can add further complexity to here. We've got a diagonal, and then we can do a double diagonal. Whoa, whoa, whoa. What is this? It's mind-blowing. All right, so here is a double diagonal, right? So we have a diagonal up here. We have a diagonal down here. We can change the width and play around with this and have all sorts of fun. And we got two little peakies here, and we can move them all around. We can push our vertical or our short all the way down, and we can push our long all the way down and create all sorts of different variations of this double diagonal and call it all sorts of weird names if we want to and label it as some sort of strategy. So there is a double diagonal. That's pretty much all of the main structures that typically people will run into. But then let's talk about what constitutes as a strategy. Well, what constitutes as a strategy is when we start to add specific rule sets to a structure. So a structure is an option structure in which, you buy and sell, or you buy a certain option or something like that, right? A strategy is where we take a structure and we overlay a set of rules on it to create a consistent trade that grows an account over time. So that's the difference between a structure and a strategy, right? It's a systematic way of attacking the market using a set of structures or just a structure and achieving some sort of profit from it. So let's just take an example. And this is a much older strategy that was popular quite a few years back, I think probably in 2016 or so. But one of these popular strategies would be something like this. Let me kind of make this here. Alrighty then. So here is our little structure here. And what we did here is, let me just kind of make sure we tune this. This probably can go up here. We're not quite perfect, but this is pretty close. What we did here is we had a very specific rule set. So this is a strategy of buying a 60 delta, a 40 delta, and a 20 delta, or basically 20-ish in this case. And when you do this, it creates a butterfly, right? And so as we go through this 20, 60, 40, this thing can make a certain amount of money, and it does very well in certain market conditions, right? And then where you do this in DTE is also part of the strategy's rules, right? Is it, I mean, I'm just throwing it here at 27 days, but let's say it's at 60 or 50 or 40 or something like that. And it creates this rule of like, okay, so every 30 days, we're going to enter a new trade. We're going to do a 20-60-40. We're going to, take the win-loss of this. We're going to capture our wins at, say, 10%. We're going to take our losses at, say, 10%. And that's going to be our consistent strategy. And we're just going to rinse and repeat that over and 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 over in the market and hope that it makes money over time. Kind of like buying stock or something like that, where it just makes money over time. And so that's where you get into a strategy. So yes, in the background here, this is a structure, and in this case, this is a broken wing butterfly, but this is also called the 20-60-40, right? And there are reasons why this structure inevitably had some challenges, but it had its brilliance as well as far as how it was set up. And so everything that we ever learn about options, and I learned a lot from this strategy back in the day, and I believe the guy that made it, just so that I give credit for it, was Andrew Faldy, a very amazing gentleman. I've had the pleasure to talk to him a few times, and I'm so impressed by him. He's a really great guy. So he made this strategy, and he's got certain rule sets behind it and things like that. But of course, it had and has its challenges in today's markets, and especially after 2018 and things like that. But the whole point behind this is that is a strategy. Now, I have certain strategies at Environmental Trading Edge, and my strategies go from some simple structures, something similar to this or something like that, to more complex structures like what we see in the dailies, where I have various different structures where they are like a flat butterfly, and I'm just going to kind of throw something together, but you have something like a flat butterfly, and then you also end up having another structure built onto it. So say like in this case, we'd end up putting a vertical up here and doing something like this. Like, I'm just throwing something together, but my strategies are like this. We go a little bit more complex than most of the time than just a single structure. We have a structure that's hedged by another structure. So we kind of take the whole point of hedging to the nth degree of having structures hedge other structures based on the environment and what is conducive for them based on historical data and also mathematical principles of how options are priced, and then based on my own options pricing models. And so that's what we do at Environmental Trading Edge, but that's what the strategy comes in, right? Then also a strategy takes it one step further, or at least should, and all of my strategies do. They also vary the amount of allocation in each strategy. So per se, do I want to put all of my capital in this structure today? Well, maybe, maybe not. I doubt that it would ever be 100% of your capital in this structure, but that would be one way. So a strategy should tell us what structures or combinations of structures to put on today, and tell us how much to risk. So that way we can consistently grow our account over time. And that's what we do at Environmental Trading Edge, or etradingedge.com. And we've had a great success all year, and we will continue to. All right. So from there, we will march on. And I think that pretty much plugs in all the questions that I've gotten. And hopefully I clarified structures and strategies. But I wanted to definitely put this out there so that way you guys can learn the difference between some of these basic things of structures and strategies. And now we will get that going forward. And if you ever need to reference back to this, I'll probably throw it up on our video page and things like that. And if you have any other questions at any other times, let me know, and I'll see you guys next week.